This is Financial Accounting, and I'm Dr. Baldwin. In this lecture, we'll complete the accounting cycle for Bart & Company, discuss two different income statement presentations, and two new financial statement analysis ratios. It sounds like a lot, but really it's a short lecture. Let's pick up where we left off in the previous lecture and complete the accounting cycle by preparing the closing entries for Bart & Company. So, here we have Bart & Company's adjusted trial balance. See everything you normally see on an adjusted trial balance. Because this is a merchandising company, we have a few more accounts than we had before, because you can see things in this one, for example, for sales discounts and sales returns. We've got a few new accounts here. Step one is to close sales to income summary. So since sales has a credit balance, we'll debit it to close it to credit income summary. After this entry, the income summary account has a credit balance that reflects the sales for the period. That's all that's been put into income summary, just this one thing. Step two is to close all the accounts with a debit balance to income summary, all the temporary accounts with a debit balance. This includes all the expense accounts as well as sales discounts and sales returns. Since these accounts all have debit balances, we'll credit them and debit income summary for their total. After this entry, the balance in the income summary represents the net income. Step three is to close income summary to retained earnings. In this case, income summary had a credit balance of $12,900, so we need to debit income summary to close it and credit the retained earnings account. Now the balance in income summary is zero. Step four, the final step, is to close the dividends account directly to the retained earnings account. Since the dividends account has a debit balance, we need to credit it to close it and debit the retained earnings account. Now, let's look at two formats for preparing an income statement using these data: the multi-step format and the single-step format. The one you're seeing at the moment is the multi-step format. The multi-step format has multiple subtotals before arriving at net income. This format provides more detailed information for users. The main subtotals on this income statement are net sales, which you can see right here. That's our sales, less sales discounts and sales returns and allowances. That's net sales. The next main subtotal is gross profit. That's net sales minus cost of goods sold to get gross profit. And the next big subtotal, of course, is the final total, which in this case is net income. So gross profit minus the operating expenses equals net income. For a merchandising company, we figure out our net sales, we subtract out our cost of goods sold to get gross profit. Some people call it gross margin. To get gross profit, and then we subtract out all of the operating expenses. And you can see here we've subtotaled selling expenses separately from general and administrative. That's pretty common. But we have a total of the operating expenses subtracted from the gross profit, and that gives us net income. This is the same information presented in a single-step income statement. In a single-step income statement, all the revenues are grouped together. So here's our net sales. We've just netted them out instead of showing all the steps. All the revenues are grouped together and totaled, and all the expenses are grouped together and totaled. So here's all of our expenses: cost of goods sold and operating expenses. We just lumped all those operating expenses into one number and got the total expenses. We subtract the total expenses from the net sales, and that gives us net income. As you can see, the net income is the same whether we use the multiple step or the single step income statement. The only difference is the amount of detail that is provided on the income statement. On the balance sheet, the merchandising company will have an account titled Merchandise Inventory. You can see it right here. It's a current asset, so it's listed pretty high here. Usually cash and receivables are listed first, but then inventory. Service companies will not have this account since they do not sell inventory. This chapter concludes in the financial statement analysis section with two common ratios: the acid test ratio and the gross margin ratio. The acid test ratio is a common ratio that is used to determine the liquidity of a company. In other words, this ratio determines if the company has enough liquid assets to pay its current liabilities. Not just its current assets, but its really, really liquid ones. The ratio is calculated as quick assets divided by current liabilities. You may remember the current ratio was current assets divided by current liabilities. Well, what we're doing here is we're limiting what's going on the top of the fraction. Quick assets include cash, short-term investments, and receivables. A common rule of thumb is for the acid test ratio to be at least 1.0, but this can vary from industry to industry. The gross margin ratio is another common ratio that calculates the percentage of dollar sales available to cover expenses and provide a profit. This ratio is calculated as gross margin divided by net sales. So we've got our net sales minus our cost of goods sold, which is also referred to as gross margin or gross profit, and we're dividing that by net sales. It's just going to give us a percentage. Remember, gross margin is net sales minus cost of goods sold. In most cases, the higher the ratio is, the better. That concludes this lecture, and that concludes Chapter 4. In this chapter, we've learned about recording purchases and sales of merchandise inventory and how to record discounts and returns and allowances. We've also reviewed the closing process, and we're introduced to the multi-step income statement. You need to move on to the next homework assignment, the second homework assignment in Chapter 4. Remember, you want to keep spreading these assignments over 2 or 3 days to lighten the load. You don't want to wait till the last minute to start. Good luck.